Most traders are after some kind of a trading system which has a really high hit rate. The people are always looking for that holy grail of trading systems which comes with a 90% success rate. But in this video, I want to talk about how managing your winners and losers is the key for you to become profitable in trading. It's not about a high hit rate trading system. Well, I remember when I started doing options trading, I was doing I was selling premium, selling credit spreads, which is what is the in thing these days, right? Everybody wants to sell premium. Now, with the nature of spread selling is that you are always selling approximately at two standard deviation, and that brings in a really high hit rate. The thing that people don't understand is that having a high hit rate means nothing if you're not managing your winners and losers. For example, having a really high hit rate um, with credit spreads could mean that you have 8 winners out and 2 losers out of every 10 trades. But the 2 losers that you have, the drawdowns will be so huge that they will cancel out all the wins that you had in the past. You may have heard the term picking up coins in front of a freight train. I hope you understand the analogy. So your wins are really small. You get a lot of wins. Um, so in the freight train example, you are picking up coins and you may pick like 100, 200 coins and you're feeling happy, but there's a freight train coming towards you, and once it hits you, it's game over. So the same thing applies to trading too. So if you have a high win rate, high probability trading system, the drawdowns are usually so huge that they will cancel out all previous winners, and that is why you need to have really good system in place to manage your winners and losers. I want to explore the kind of returns that you can expect when you apply this method properly. So I'll just run through a few simulations, few numbers, change a few numbers here and there, and show you how that affects your returns and why are my profit and loss targets so important for this method to play out. So I've made some assumptions which I want to go over. So for example, in this case, I chose a hypothetical portfolio of with $100,000 starting value. You can change it to $10,000 if you want. The numbers are the same. It doesn't, because we are talking about percentages. It just makes it easy for you to see calculations. Starting value, and then based on the parameters which I will walk you through, it will show you the ROI you can expect at the end of a year in terms of percentage, and then the ending value of your account. I've also assumed that you are following the profit target of closing your trades, profitable trades at 94% ROI, and closing your losers at 50% loss. This is critical for this method to function properly, because unless you have positive expectancy in your trading plan, you will not succeed. The math just doesn't work. So now on the left side, there is this column called month, and I've gone from January to December. A simulation of taking trades for over a period of 12 months. Then I have allocation percentage for each month. So when the conditions are ideal, I trade with 30% allocation in my portfolio. And then these columns are auto calculated, the ones in the gray. For example, it automatically calculated that since you started with 100,000 and you use 30% of it, that means you have $30,000 available to you to put trades on. And then obviously if you have $30,000, then the amount risk per trade will be higher. uh, if you assume that you're doing $5 widespread, which risks $250 per trade, to spend $1,000 per trade, you would have to increase your contracts, which is shown in this column. So four contracts would take your trade to $1,000. And then based on that, it's also calculating how many trades would you be taking in a month. So it's showing you 30 trades in this case. And if you're part of our Discord group, you must have noticed that I actually do take around 10 trades per week. So it averages out around to 40 trades per around 40 trades per month. Now, again, in ideal conditions, my win rate is usually between 70 to 80%. And if you were in our group in the years 2020 and 2021, you must have remembered that the win percentage was around this number. So I've just fixed it to 70% for now, and to show you what kind of results you can expect. And then it's also auto calculating. If your win percentage is 70%, and you're taking 30 trades, it's auto calculating how many winners you will have and how many losers you will have, what amount um, what is the amount of money your winners will bring in, and how much money will you lose in those losing trades. And then at the end of each month, it recalculates the net lick of your account. And so this is how the sheet is laid out. So the most basic example is 30% allocation. Win percentage is 70% every month. Obviously, in real life, it'll not be this consistent, but this is just to show you what kind of results you can expect. So, assuming you have 70% returns every month, which is a very high hit rate, I know that in real life this may not happen, but assuming that is the case and you close your winners at 94%, close your losers at 50% loss, you could expect around 450, almost 500% returns in your portfolio. And I was able to demonstrate to our members back in 2020 and 2021, where I actually made 1000% returns in my portfolio, um, which was way higher than this. Because at that time, like if you remember at the beginning of this video, I mentioned that my win rate is between 70 to 80% during ideal conditions. Um, so, if, for example, if you take it to 80%, it starts approaching 1000%. So, anyway, so that's the ideal situation. Now, let's start moving some numbers around and see how those returns can get affected. So, the first thing I want to mention is in a year like this, my returns are not that great this year because of unpredictable market conditions, news driven markets. You could have winners showing for the next 4 weeks, a lot of winners showing, and then a piece of news comes out like, CPI, PPI, some kind of jobs number, which completely changes market direction in the matter of a day. So because of that, the markets are very unpredictable this year. And so your returns will also be, your win percentage will also be not consistent in a year like this. So let's say your win percentage is really bad. Let's take it down to 55%. Okay, so it's almost like a coin flip. So 50% is coin flip, one winner, one loser. I'm just taking it above 50% because there's no point even trading if your win rate is 50%. So let's assume that it's a really bad win rate at 55% each month. Now, even with that win rate, if you close your winners at 94% and losers at 50%, you can still expect 174% ROI. That is a massive return in a year like this. If you give your money to a hedge fund, most likely they will give you 20-25% returns, and most people are very happy with those kind of returns. These returns are really impressive with that kind of a win rate. Now let's keep that win rate to that number, and do something. So I want to point out the profit and loss targets, the importance of profit and loss targets. In fact, recently I was doing some live sessions in our group, and one member emailed me this question saying that his win rate was actually around 53%. So let's change to 53% and simulate what was happening with him. So 53%, if you just change the win rate to 53%, you are still looking at a very impressive returns. Now the problem with him was, but he was taking all his losses to 100%. So he was just, instead of managing losers, he was holding on to hope until the last day and then taking those losers to 100% loss. So if you just make that small change, just look at your ROI. It drops to 11%. So just by managing losers correctly, your ROI can go from 11% to 150%. That is why this uh, 50% loss rule exists. Now, in real life, because we are talking about real life scenarios, right? So, in real life, what will happen is many members, in fact, shared this with me that they are hardly ever able to close trades at 50% loss, because by the time the trade hits 50% loss and they put in their closing order at 50% loss, the stocks continues to go against them, and then they might see 60, 70, 80% loss. So based on my experience, what I've noticed is, if you the day your trade loses 50% of its value, you put in a closing order at 50% loss. Your limit price should be 50% of what you paid, and you let it ride for, let's say, 3 days. In those 3 days, if the stock doesn't close, if the trade doesn't close for 50% loss, at that point, what you need to do is you need to just get out at what you can get. And again, based on my experience, no matter how bad it is, I'm always able to get out between 65 to 70% loss. It hardly ever happens that my trade goes away from me so fast that it's next thing I know, I'm looking at 80% loss. That only happens if you ignore the 50% loss rule and you're holding on to hope instead of managing your losers. So let's say that you are able to get out of all trade at 65% loss. You are still looking at almost 100% returns in that year with a really bad win rate of 53%. Now, one more thing I want to point out is the same member, what he was doing was, he was actually, not only was he taking his trades to 100% loss, he had become fearful. So the few winners that he had, he was not sure, and he was actually closing winners at 70% profit only. So now you are looking at losses. So if you don't follow these numbers, it doesn't matter what your win rate is, your returns will the returns that you want will never come. So just wanted to point out why this is so important for you to manage this at 94% profit and 50% loss. Hope that helps and explains to you why in my system I have all these rules and the significance of applying those rules to your trading.